Hello, friends. Market Wizards is a book about how the best traders in the world think, decide, and control themselves when money, risk, and uncertainty are on the line. In this video, I've covered all top 17 traders' interview lessons into 17 parts, where you listen and learn their trading success experiences. Friends, this book is not here to impress you. It is here to prepare you. If you are a trader, an investor, or someone who wants to understand decision-making under pressure, this video will change how you look at markets and at yourself. Let's begin our journey into Market Wizards. Part 1. Bruce Kovner. Friends, Jack Schwager begins Market Wizards with Bruce Kovner because this interview quietly explains something most traders never learn, even after years in the market. Before strategies, before systems, before indicators, there is a mental responsibility that decides whether a trader survives long enough to succeed. Bruce Kovner represents that responsibility in its purest form. Kovner's entry into trading was not smooth or confident. When Schwager explores his early experience, we learn that Kovner's first major trade was emotionally overwhelming. He committed too much capital relative to his emotional tolerance. When the market moved against him, fear took control. His thinking became distorted. His focus narrowed. Instead of calmly analyzing information, he became consumed by anxiety. That trade did not just threaten his account, it threatened his psychological stability. This moment became the defining turning point of his career. Kovner realized that the real danger in trading is not volatility. It is exposure beyond emotional capacity. From that day forward, he made a decision that would guide every trade he ever placed. He would never allow a position to control his emotional state. Schwager emphasizes that Kovner redefined risk in a way most traders never consider. Risk, in Kovner's view, is not measured only in dollars. It is measured in stress. If a position can cause emotional pain, hesitation, or fear, then the position is already wrong, regardless of how attractive the opportunity appears. Kovner explains that before entering any trade, he imagines the worst possible outcome. He mentally accepts that loss in advance. If the thought of that loss disturbs his emotional balance, he immediately reduces the position size or abandons the trade entirely. This practice removes fear before it has a chance to appear. Friends, this is a critical point. Most traders enter trades hoping they will work. Kovner enters trades already prepared for failure. That preparation is what gives him clarity when others panic. As Schwager continues, another key principle emerges. Kovner does not believe that markets can be predicted consistently. He believes that markets are driven by uncertainty, randomness, and changing conditions. His edge does not come from knowing what will happen next. It comes from knowing how to respond when things do not go as expected. This mindset frees him from emotional attachment. He does not need to defend opinions. He does not argue with price. He treats his market views as temporary interpretations, not permanent truths. When new information appears, he adapts immediately. There is no hesitation, no frustration, no ego involved. Schwager highlights that Kovner's confidence is rooted in this acceptance of uncertainty. Kovner does not need certainty to act. He needs only a logical framework and controlled risk. Because of this, losses do not damage his confidence. They are part of the process. They do not require explanation or justification. Another important aspect of this is Kovner's macro perspective. He studies global markets as interconnected systems. Interest rates influence currencies. Currencies influence commodities. Political decisions influence capital flows. But even with this broad understanding, Kovner never allows his opinions to override discipline. He may strongly believe in a macro trend, but belief does not increase position size. Risk always comes first. Schwager makes it clear that Kovner separates analysis from execution. Analysis guides direction. Execution is governed by risk control. Friends, this separation is rare. Most traders confuse conviction with justification for larger risk. Kovner never does this. He understands that the market does not reward confidence. It rewards discipline. Kovner warns against stubbornness more than almost any other psychological flaw. If the market proves a position wrong, the correct response is immediate exit, not adjustment, not rationalization. He believes that the market's feedback must be respected at all times. This ability to exit without emotional resistance is one of the strongest signs of professional maturity. Kovner does not feel embarrassed by being wrong. He feels responsible for responding correctly. As the interview deepens, Schwager subtly reveals why this lesson is placed first in the book. Before readers meet traders with different systems and styles, they must understand one universal truth. Trading is an emotional profession. Without emotional control, no strategy can survive. Kovner explains that true confidence does not come from winning. Winning can inflate ego and increase risk. Real confidence comes from knowing that you can endure losing periods without psychological damage. When a trader reaches that point, fear loses its power. Jack Schwager uses this interview to quietly establish the foundation for everything that follows. The traders you will hear from later use different methods. Some are aggressive, some are systematic, some are discretionary, but all of them share the mindset Kovner represents: respect for risk, acceptance of uncertainty, and emotional discipline. This teaches us that markets do not defeat traders. Traders defeat themselves by ignoring their emotional limits. When you understand this, you stop trying to conquer the market. You start managing yourself. And that, friends, is where real trading mastery begins. Part 2. Richard Dennis. Jack Schwager turns to Richard Dennis. In the second part, the conversation shifts from emotional survival to something equally important: whether trading skill is something you are born with or something you can be taught. Richard Dennis is the perfect person to answer that question because his career challenged one of the biggest myths in trading, that success depends on rare intuition or special talent. Dennis started young, with very little capital and no privileged access. What he did have was curiosity and discipline. Schwager walks us through Dennis's early years, and what becomes clear is that Dennis was not driven by prediction. He was driven by observation. He noticed that markets trend. More importantly, he noticed that most people fail not because trends do not exist, but because they cannot follow rules when emotions rise. As Dennis's career progressed, he became one of the most successful futures traders of his time. But instead of guarding his methods as secrets, he became fascinated by a deeper question. He wanted to know whether discipline could be trained, whether ordinary people, given a clear system and strict rules, could trade successfully without intuition. This curiosity led to what became known as the turtle experiment. Schwager explains that Dennis believed trading could be reduced to a set of rules: entries, exits, position sizing, and risk limits. If those rules were followed exactly, emotional interference would be minimized. To test this belief, Dennis recruited a group of people with diverse backgrounds. Some had no trading experience at all. Friends, Dennis taught these individuals a simple, trend-following system. The rules were not complex. Buy breakouts, sell breakdowns. Cut losses quickly, let winners run. Risk only a small percentage of capital on any trade. What mattered was not creativity, but obedience. Schwager makes it clear that the results were undeniable. Many of the turtles became profitable traders. This directly challenged the idea that trading success requires natural instincts. Dennis proved that discipline and consistency matter more than brilliance. Dennis's philosophy is grounded in one core belief: markets reward those who can act without hesitation when rules are met. He understood that hesitation comes from fear, and fear comes from uncertainty. Rules remove uncertainty. When rules are clear, decisions become mechanical rather than emotional. One of the most important insights Schwager draws from this interview is Dennis's attitude toward losses. Dennis does not see losses as mistakes. He sees them as costs. Trend-following systems naturally produce many small losses. The edge appears when a large trend develops, and the trader stays with it long enough. Friends, this is psychologically difficult. Most people want to be right more often than wrong. Dennis accepts being wrong frequently. What he cares about is the size of wins relative to losses, not the win rate. This probabilistic thinking separates professionals from amateurs. Another key element of Dennis's approach is position sizing. He understands that even a great system can fail if risk is mismanaged. By risking only a small portion of capital on each trade, he ensures survival through drawdowns. This allows the system's edge to express itself over time. Schwager also explores the emotional challenges the turtles faced. Some followed the rules strictly and succeeded. Others deviated when fear or greed took over. The difference in results did not come from intelligence. It came from discipline. Dennis's experiment revealed that knowing the rules is not the same as following them. Schwager wants readers to understand: markets are not difficult because they are complex. They are difficult because they expose human weaknesses. Fear of loss, desire for certainty, need for control. Dennis's system worked not because it was perfect, but because it addressed these weaknesses directly. Dennis also speaks about patience. Trend following requires waiting. Long periods of inactivity are common. Many traders sabotage themselves by trading out of boredom. Dennis avoided this by trusting his system and accepting inactivity as part of the process. Richard Dennis shows that discipline can outperform intuition. But he also delivers a warning. Rules only work if you respect them under pressure. When drawdowns occur, the temptation to abandon the system is strongest. That is where most traders fail. Schwager positions this interview right after Bruce Kovner intentionally. Kovner teaches emotional survival. Dennis teaches rule-based execution. Together they form the psychological backbone of professional trading. Trading success is not mysterious. It is difficult because it requires doing simple things consistently while ignoring powerful emotional impulses. Very few people can do that. Those who can, like Richard Dennis, achieve extraordinary results. Markets do not reward intelligence alone. They reward discipline, patience, and the courage to follow rules when emotions are screaming to do the opposite. Part 3. Paul Tudor Jones. Jack Schwager introduces Paul Tudor Jones. After learning emotional survival from Bruce Kovner and rule-based discipline from Richard Dennis, we now step into a lesson about intensity, adaptability, and respect for risk at the highest level. Paul Tudor Jones is not calm and distant in the way some traders are. He is sharp, alert, and deeply engaged with the market every single day. Yet beneath that intensity lies an iron discipline that never breaks. Paul Tudor Jones believes one thing more strongly than almost anything else: the market is always bigger than you. No matter how experienced or confident you become, the market can humble you instantly if you stop respecting risk. Schwager makes it clear that Jones's greatest strength is not prediction. It is his refusal to let ego interfere with survival. Jones began his trading career by studying market history obsessively. He believed that human behavior repeats itself, especially under stress. Panics, bubbles, crashes. These are not random events. They are emotional patterns. But knowing history does not mean predicting the future with certainty. It means recognizing when the present begins to rhyme with the past. Friends, this is a subtle but powerful distinction. Jones does not try to forecast exact turning points. He watches for emotional extremes. When fear or greed reaches unsustainable levels, he prepares, not to fight the market, but to manage risk aggressively. One of the most important things Schwager draws from this interview is Jones's relationship with losses. Paul Tudor Jones hates losing more than he loves winning. But he does not deny losses. He embraces them early. When a trade does not behave as expected, he exits quickly. He does not wait. He does not hope. He does not negotiate. Jones explains that the most dangerous trades are the ones where you are emotionally invested. The moment you start defending a position, you stop seeing reality. For this reason, he keeps losses small and exits fast. This allows him to stay mentally flexible and emotionally clear. Friends, many traders misunderstand this. They think great traders have massive risk tolerance. In reality, traders like Jones have very low tolerance for being wrong. They accept small losses willingly so that they never face catastrophic ones. Schwager also explores Jones's use of technical analysis. Jones respects charts, but he does not worship them. He sees them as tools to understand crowd psychology, not as magic predictors. Price action reveals fear, confidence, hesitation, and conviction. When price contradicts his expectations, he trusts price over opinion every time. Another defining trait of Jones's approach is adaptability. He believes that the worst mistake a trader can make is becoming married to a market view. Markets change character. Volatility shifts. Participants evolve. What worked last year may fail this year. Jones survives because he adapts faster than most. Friends, adaptability requires humility. It requires admitting that yesterday's success does not guarantee today's relevance. Jones constantly reassesses his assumptions. This keeps him sharp, but it also keeps him emotionally neutral. He is never shocked by market behavior because he expects uncertainty. Schwager highlights Jones's strict risk management rules. Jones limits exposure aggressively, especially during periods of uncertainty. He does not press trades just to stay active. If conditions are unclear, he reduces size or steps aside entirely. This ability to wait is one of his greatest strengths. Jones also emphasizes the importance of self-awareness. He knows when he is trading well and when he is not. During periods of emotional fatigue or overconfidence, he reduces risk. This self-regulation protects him from himself. This is a recurring theme throughout Market Wizards. The greatest threat to traders is not the market. It is their own emotional state. Jones understands this deeply. He treats trading as a performance profession. Just as athletes manage physical condition, traders must manage mental condition. Jones's belief that defense comes before offense. He says that if you focus on protecting capital, opportunities will naturally appear. But if you focus on making money, you will take unnecessary risks. This reversal of priorities is what allows him to stay consistent. Schwager also discusses Jones's awareness of crowd behavior. Jones looks for moments when consensus becomes extreme. When everyone believes the same thing, risk increases. Markets move not on what is known, but on what surprises. Jones positions himself to benefit from those surprises, but only with controlled risk. Paul Tudor Jones is aggressive, when conditions are right, but never reckless. His aggression is always bounded by risk limits. His confidence is always balanced by humility. Jack Schwager includes this interview to show that even the most dynamic, fast-moving traders survive by respecting the same principles we have already seen: emotional control, risk management, and adaptability. Great traders are not fearless. They are fear-aware. They understand fear, respect it, and design their behavior so that fear never controls decisions. Success in trading does not come from boldness alone. It comes from knowing when to press and when to step back, from acting decisively without becoming attached, from staying alert without becoming emotional. Friends, Paul Tudor Jones shows us that intensity and discipline are not opposites. When combined correctly, they create one of the most powerful trading mindsets in the world. Part 4. Mark Weinstein. Friends, when Jack Schwager brings Mark Weinstein into Market Wizards, the conversation moves toward a quieter but extremely powerful idea: the art of waiting. Weinstein is not a trader who needs constant action. He does not chase excitement. He does not feel pressure to participate in every move. His strength comes from patience, selectivity, and an almost obsessive focus on entering trades where risk is unusually low. Schwager makes it clear early in this lesson that Weinstein thinks very differently from most traders. Where others look for opportunities, Weinstein looks for conditions. He believes that most of the time, the market is not offering a real edge. Trading during those periods is not activity, it is gambling. His job is to wait until the market presents a situation where the odds are clearly skewed in his favor. Weinstein explains that the key to his success is not prediction, but positioning. He does not need to know what the market will do. He only needs to know where he is wrong. This mindset allows him to structure trades with very tight risk and large potential reward. If the market does not behave as expected, he exits quickly and calmly. Friends, this idea might sound simple, but it is emotionally difficult. Most traders feel uncomfortable waiting. They feel pressure to trade because they equate activity with productivity. Weinstein rejects this entirely. He believes that not trading is often the most professional decision a trader can make. Schwager explores Weinstein's background as a market maker, and this experience deeply shaped his thinking. As a market maker, Weinstein was constantly exposed to order flow. He learned how easily traders reveal their emotional weaknesses through poor entries and panic exits. This experience taught him one essential truth: the crowd is usually wrong at emotional extremes. Weinstein's strategy revolves around finding moments when the market is stretched too far in one direction. These moments create opportunities where risk can be defined very tightly. He is not interested in being early. He is interested in being right with controlled risk. Schwager highlights is Weinstein's strict avoidance of hope. Weinstein believes hope is poison in trading. The moment a trader hopes, they stop thinking objectively. For this reason, Weinstein never allows a trade to move significantly against him. If the market violates his risk level, the trade is over. No debate, no justification. Friends, this discipline creates emotional clarity. Because Weinstein exits quickly when wrong, he never becomes emotionally attached to positions. He does not experience the anxiety that comes from watching losses grow. This allows him to remain patient and wait for the next high-quality opportunity. Schwager also emphasizes Weinstein's belief that good trades feel uncomfortable at entry. When a trade feels easy or obvious, it usually means the crowd is already positioned. Weinstein looks for trades where he is slightly early, but not reckless. He wants to enter near points where others are emotionally exhausted. Weinstein also talks about the importance of confidence that comes from preparation. His confidence does not come from bravado or prediction. It comes from knowing that his risk is limited and his process is sound. This allows him to stay calm even during volatile periods. Long stretches of inactivity do not bother him. He understands that trading is not entertainment. It is decision-making under uncertainty. Waiting is part of the job. Weinstein teaches us that overtrading is often a response to emotional discomfort, not market opportunity. By learning to wait, traders eliminate many unnecessary losses. Schwager includes this interview to show that successful traders do not all look the same. Some are aggressive, some are systematic. Weinstein represents the trader who wins by doing less but doing it better. Mark Weinstein's approach reminds us that trading is not about being involved. It is about being selective. Friends, sometimes the most powerful action a trader can take is no action at all. When you wait for clarity and control risk tightly, the market eventually offers opportunities worth taking. Part 5. Larry Hite. Jack Schwager introduces Larry Hite, the world of systems, probabilities, and emotional neutrality. Hite represents a trader who removed himself from the decision-making process as much as possible, not because he lacked confidence, but because he understood human weakness too well to trust it under pressure. Larry Hite did not begin as a confident market participant. In fact, his early experiences were marked by inconsistency and emotional decision-making. Schwager explains that Hite struggled when he relied on opinions and intuition. He would hesitate, second-guess, and rationalize losses. Over time, Hite realized that his greatest enemy was not the market. It was his own reactions to uncertainty. This realization pushed him toward a radical idea. If emotions distort decisions, then decisions should be automated. Hite began developing mechanical trading systems that removed discretion. The system decided when to enter, when to exit, and how much to risk. His job became execution, not interpretation. Friends, this shift is more psychological than technical. Hite understood that humans are terrible at consistency. We change behavior after losses. We become overconfident after wins. Systems do not do this. Systems do exactly what they are designed to do. Nothing more, nothing less. One of the most important principles Schwager highlights is Hite's belief that you do not need to know what will happen next to make money. You only need to know how to respond when outcomes unfold. Hite embraced probability. He accepted that any individual trade is random, but a large series of trades governed by an edge will produce predictable results. This mindset completely changed his emotional relationship with trading. Losses no longer felt personal. They were expected. They were built into the system. Hite often says that if you are surprised by losses, you do not understand your system well enough. Schwager spends considerable time exploring Hite's approach to risk. For Hite, risk management is not a secondary consideration. It is the core of the business. He believes that survival is the first objective of trading. Profits come only after survival is ensured. Hite limits risk aggressively. He never allows a single trade, or even a series of trades, to threaten long-term capital. By keeping losses small and consistent, he ensures that no emotional damage accumulates. This emotional stability allows him to stay committed to the system during inevitable drawdowns. Friends, this is where many traders fail. They abandon systems during losing streaks, not because the system stopped working, but because they stopped believing. Hite avoids this by understanding drawdowns as statistical events, not personal failures. Hite may believe in his system, but belief does not alter behavior. The rules are followed regardless of confidence, fear, or recent performance. This rigid adherence is what gives the system its power. Hite also emphasizes diversification. No single market, strategy, or idea deserves absolute trust. By spreading risk across markets and systems, he reduces dependence on any one outcome. This further stabilizes both capital and emotions. Friends, notice the pattern emerging across these lessons. Great traders design their behavior to protect themselves from emotional impulses. Hite does this by outsourcing decisions to rules. Where others rely on willpower, Hite relies on structure. Schwager also explores Hite's humility. Hite openly admits that markets are unpredictable. This admission does not weaken him, it strengthens him. Because he does not expect certainty, he is never shocked by volatility. He is prepared for it. Hite's view on mistakes. He believes mistakes are not losing trades. Mistakes are deviations from the system. As long as he follows the rules, outcomes are irrelevant in the short term. This mindset creates emotional resilience. Friends, discipline does not come from motivation. It comes from design. If you design a process that removes emotional decision points, discipline becomes automatic. Jack Schwager includes Larry Hite to show that one path to mastery is complete acceptance of uncertainty combined with absolute commitment to process. Hite does not seek excitement. He seeks consistency. He does not chase certainty. He manages risk. You cannot control markets. You can only control exposure, behavior, and response. Larry Hite built his success by focusing entirely on what can be controlled. Friends, peace in trading comes not from winning more often, but from trusting a well-designed process and letting probability do its work. Part 6. Michael Marcus. Michael Marcus began his career with intelligence and ambition, but without emotional control. Schwager explains that Marcus was initially drawn to the excitement of trading. He took risks aggressively and allowed emotions to guide decisions. Early success reinforced bad habits. Wins made him feel invincible. Losses made him defensive. This emotional swing created instability, even when his analysis was often correct. Friends, this is a familiar trap. Early wins convinced traders that risk does not matter. Marcus fell into this trap, and the market eventually corrected him hard. One severe loss wiped out a significant portion of his capital. But more importantly, it shattered his confidence. That moment forced him to confront a painful truth. Intelligence without discipline is dangerous. Schwager highlights this turning point carefully. Marcus did not quit. He reflected. He realized that his biggest losses came not from bad ideas, but from oversized positions. He had confused conviction with justification. From that realization, he rebuilt his approach around risk first, ideas second. Marcus learned that the market rewards traders who grow in stages. He accepted that consistency must come before scale. He reduced position size drastically and focused on execution quality. This shift allowed him to regain confidence slowly, without emotional pressure. Friends, this is one of the most important psychological lessons in the book. Confidence cannot be forced. It must be earned through controlled exposure. Marcus stopped trying to win big and started trying to trade well. Over time, performance improved naturally. Schwager also explores Marcus's view on learning from losses. Marcus believes that losses are the market's way of teaching discipline, but only if the trader listens. If losses are blamed on the market, learning stops. If losses are examined honestly, growth begins. Marcus's understanding of scaling. He explains that traders should increase size only when emotional stability is proven. Profits alone are not enough. If a trader feels anxiety, fear, or overconfidence, size is increased too early. This insight protects traders from self-destruction. Many traders fail not because they cannot make money, but because they cannot handle making money. Increased size amplifies emotions. Marcus survived by respecting this reality. Schwager also emphasizes Marcus's flexibility. Marcus does not marry opinions. He adapts when conditions change. But unlike earlier in his career, he now adapts calmly, without emotional urgency. This emotional maturity allows him to remain objective. One of the most powerful ideas Marcus shares is that trading success is cumulative. It is built trade by trade, decision by decision. There are no shortcuts. Every shortcut increases emotional pressure, which eventually leads to mistakes. Friends, setbacks are not failures. They are necessary phases of development. Marcus's career shows that the market can be a harsh teacher, but a fair one. Jack Schwager includes Michael Marcus to show that greatness in trading is not about avoiding mistakes. It is about responding to them correctly. Marcus did not become successful because he never failed. He became successful because he learned how to fail without self-destruction. Emotional growth is not optional in trading. It is required. Traders who resist it are removed. Traders who embrace it evolve. Michael Marcus's story reminds us that the market does not demand perfection. It demands progress. Part 7. Ed Seykota. Friends, when Jack Schwager sits down with Ed Seykota, this part is not only about systems and trends, it is about self-knowledge. Seykota shows us that trading performance is inseparable from the trader's inner state. You do not get the results you want in markets. You get the results you are psychologically prepared to accept. Ed Seykota is known as one of the earliest and most successful trend followers. But Schwager makes it clear that Seykota's real edge is not technical brilliance. It is emotional honesty. Seykota understands that markets act as mirrors. They reflect back the trader's beliefs, fears, and unresolved conflicts. Seykota explains that his systems are simple by design. He follows trends. He cuts losses. He lets profits run. These rules are not revolutionary. What makes them powerful is strict adherence. He does not override signals. He does not negotiate with losses. He does not second-guess exits. The system operates the same way, regardless of market conditions. Friends, this consistency removes emotional drama. Seykota believes that most traders fail not because their systems are bad, but because they cannot follow them during stress. Fear causes hesitation. Greed causes overexposure. Ego causes rule-breaking. Seykota designs his process to eliminate these behaviors. Schwager explores Seykota's belief that traders carry emotional baggage into the market. Unresolved issues, fear of failure, need for approval, desire for excitement, find expression through trading decisions. The market becomes a stage where inner conflicts play out in real time. This is one of the most profound psychological insights in the book. Seykota openly says that traders will often sabotage themselves because part of them is uncomfortable with success. Another part is addicted to emotional intensity. Without self-awareness, these forces quietly influence behavior. Friends, this is uncomfortable to hear, but incredibly valuable. Seykota does not judge these tendencies. He observes them. He believes that growth in trading requires growth in self-understanding. The more aware you are of your emotional patterns, the less control they have over your decisions. Schwager also highlights Seykota's acceptance of losses. Seykota does not fight losses emotionally. He expects them. He designs his system knowing that many trades will fail. What matters is that losses remain small and controlled. This acceptance creates emotional neutrality. Seykota explains that when traders try to avoid losses entirely, they create larger problems. Avoiding losses leads to hesitation. Hesitation leads to missed opportunities. Missed opportunities lead to frustration. Frustration leads to impulsive behavior. This cycle destroys discipline. Friends, Seykota breaks this cycle by embracing losses as feedback. Losses are signals, not insults. They tell the trader that the market is not moving as expected. The correct response is adjustment, not emotional reaction. Another important thing is Seykota's belief in long-term thinking. He does not judge performance trade by trade. He evaluates results over large samples. This statistical perspective protects him from emotional overreaction. A losing streak does not shake his confidence. A winning streak does not inflate his ego. Schwager emphasizes that Seykota's success comes from aligning beliefs with market reality. Markets are uncertain. Outcomes are probabilistic. Control is limited. When traders accept these truths, stress decreases and execution improves. Friends, Seykota also talks about the importance of personal responsibility. He believes that traders must own their decisions completely. Blaming the market, brokers, or news events is a refusal to grow. Responsibility creates clarity. Clarity creates discipline. One of the most striking ideas in this part is Seykota's statement that everyone gets what they want from the market. Some people want excitement, some want validation, some want to avoid responsibility. The market provides these experiences faithfully, but only those who truly want consistency and discipline receive it. Schwager includes this interview to push readers beyond technique. Seykota shows that even the best systems fail in the hands of emotionally unprepared traders. Conversely, simple systems can produce extraordinary results when combined with self-awareness and discipline. Seykota would ask you to examine your beliefs, fears, and motivations. The market responds to behavior, not intentions. Trading is not just a financial activity. It is a psychological journey. The more honest you are with yourself, the clearer the market becomes. Seykota teaches us that mastery in trading is mastery of self. When you accept who you are, design systems that protect you from your weaknesses, and follow rules without emotional interference, consistency becomes possible. The market is not something to conquer. It is something to engage with honestly. When you stop fighting yourself, trading becomes simpler, calmer, and more sustainable. Part 8. Tom Baldwin. Jack Schwager introduces Tom Baldwin. The conversation takes on a different texture. This part is about experience-earned intuition, the kind that cannot be rushed, taught quickly, or copied from a book. Baldwin represents a trader whose edge developed through years of observation, repetition, and emotional refinement. His success was not built on complex indicators or rigid systems, but on an intimate feel for market behavior shaped by discipline and patience. Tom Baldwin began as a floor trader, immersed in the noise and urgency of live markets. Schwager explains that this environment forced Baldwin to learn quickly. There was no time for elaborate analysis. Decisions had to be made in real time, under pressure, with incomplete information. Over time, Baldwin learned to recognize subtle shifts in order flow, momentum, and crowd behavior. These patterns were not formulas. They were impressions built from thousands of hours of exposure. Friends, this is where many misunderstand Baldwin's approach. His intuition is not guesswork. It is structured awareness. He does not act on impulse. He acts on recognition. That recognition comes only after deep immersion in market behavior. One of the most important ideas Schwager draws out is Baldwin's respect for market rhythm. Baldwin believes markets have tempo, periods of expansion and contraction, aggression and hesitation. When traders fight this rhythm, they lose. When they align with it, execution becomes smoother and risk becomes clearer. Baldwin explains that he rarely needs to predict large moves. His strength lies in sensing when the market is ready to move and when it is not. If conditions are unclear, he steps aside. This restraint protects both capital and confidence. Friends, this restraint is critical. Baldwin does not force trades to stay active. He waits until the market presents clear behavior. When that behavior appears, he acts decisively, but never emotionally. This balance between patience and decisiveness is one of his defining traits. Schwager also explores Baldwin's relationship with losses. Baldwin accepts losses as immediate feedback. He does not analyze them emotionally. He exits quickly and reassesses. There is no attachment to being right. His goal is alignment, not validation. Baldwin's avoidance of overthinking. He believes that excessive analysis can paralyze execution. Too many indicators dilute clarity. Baldwin prefers simplicity. He focuses on price behavior, volume, and context. This keeps his decision-making clean and responsive. Friends, Baldwin's approach highlights something crucial. Complexity often hides uncertainty rather than resolving it. By simplifying inputs, Baldwin reduces confusion and emotional hesitation. Schwager also emphasizes Baldwin's discipline in sizing positions. Even when his read is strong, Baldwin never risks more than he can comfortably manage. This allows him to remain calm, even when trades move against him briefly. Emotional stability preserves clarity. Schwager discusses Baldwin's learning process. Baldwin did not attempt to trade like others. He observed what fit his temperament. Over time, he refined an approach that matched his personality. This alignment is what allowed consistency to develop. Friends, there is no universal method. What matters is coherence between mindset, method, and risk tolerance. Baldwin succeeded because his trading style reflected who he was, not who he wanted to be. Schwager includes this interview to show that not all edges are mechanical. Some are experiential, but even intuition must be grounded in discipline. Without discipline, intuition becomes impulse. Baldwin avoids this by constantly checking behavior against risk and context. Experience is not just time spent trading. It is time spent observing yourself under pressure. Baldwin's calm presence in the market comes from knowing his reactions and respecting his limits. Friends, Tom Baldwin teaches us that intuition is earned, not assumed. It develops slowly through patience, humility, and repetition. When paired with discipline and risk control, it becomes a powerful edge. Part 9. Randy McKay. Jack Schwager introduces Randy McKay. McKay is not a cautious observer like some of the earlier traders. He is active, opportunistic, and decisive. But what keeps his aggression from turning into recklessness is a deep respect for risk and an unusual level of emotional honesty. Randy McKay's trading career began with a clear understanding of one truth. Markets reward those who act, but punish those who act without control. Schwager explains that McKay was naturally aggressive. He liked movement. He liked momentum. He was drawn to trades that moved quickly and decisively. However, early on, this aggressiveness caused problems. Big wins were followed by painful losses. Emotional swings became exhausting. Friends, this is a pattern many traders recognize. Aggression feels powerful when it works, but without structure, it destroys consistency. McKay learned this the hard way. Instead of suppressing his aggressive nature, he chose a smarter path. He learned how to contain it. Schwager highlights that McKay's breakthrough came when he began defining risk with absolute clarity. Before entering any trade, McKay knew exactly how much he was willing to lose. That number was non-negotiable. If price reached that point, the trade was over. There was no room for hope or adjustment. This rule transformed his trading. Once risk was capped, McKay could act decisively without emotional hesitation. He no longer feared entering trades because the downside was already accepted. This acceptance removed hesitation and increased execution quality. Friends, notice how this connects with earlier lessons. Kovner taught emotional survival. Dennis taught rules. Hite taught systems. McKay shows how aggression becomes productive only when risk is tightly controlled. Another important thing Schwager explores is McKay's relationship with losing streaks. McKay accepts that aggressive styles naturally experience volatility in results. There will be periods of rapid gains and periods of drawdowns. What matters is not avoiding these cycles, but managing exposure during them. McKay reduces size when results deteriorate. This protects both capital and confidence. When performance improves, size increases gradually. This dynamic adjustment keeps emotions balanced and prevents destructive overconfidence. Friends, this is a sign of maturity. McKay does not try to power through bad periods. He listens to feedback. He adapts. This flexibility allows him to stay in the game long term. Schwager also emphasizes McKay's refusal to become emotionally attached to positions. McKay does not identify with trades. A trade is simply a probability. When the probability fails, the trade ends. This detachment allows him to move quickly from loss to opportunity without emotional residue. McKay's emphasis on self-awareness. McKay knows when he is trading well and when he is forcing trades. During periods of emotional agitation, anger, frustration, impatience, he steps back. He understands that emotional state directly influences decision quality. Friends, this self-monitoring is critical for aggressive traders. Aggression without awareness turns into impulse. McKay avoids this by constantly checking his internal state. Schwager also explores McKay's approach to confidence. McKay's confidence does not come from believing he is right. It comes from knowing he will respond correctly whether he is right or wrong. This distinction is subtle but powerful. It removes emotional pressure from outcomes. Opportunity is abundant, but capital is finite. Missing a trade does not matter. Protecting capital does. This belief prevents impulsive chasing and overtrading. Friends, this lesson is especially valuable for traders who feel drawn to fast-moving markets. McKay shows that speed is not the enemy. Lack of control is. When aggression is paired with discipline, it becomes a strength rather than a liability. Schwager includes Randy McKay to demonstrate that there is room in the market for many personalities. You do not need to be calm and passive to succeed, but you must design rules that contain your natural tendencies. You cannot change who you are, but you can change how you express it. McKay succeeded by accepting his aggressive nature and building a framework that kept it productive. Randy McKay teaches us that boldness is not a problem in trading. Uncontrolled boldness is. When risk is defined, emotions are managed, and self-awareness is present, even aggressive styles can achieve long-term success. Part 10. Peter Steidlmayer. When Jack Schwager introduces Peter Steidlmayer, the book shifts into a deeper understanding of market structure and participant behavior. Steidlmayer is not focused on prediction in the traditional sense. He is focused on context. His work asks a different question, not where will price go next, but why is price behaving this way right now? Steidlmayer's background as a floor trader gave him a unique perspective. Standing inside the market every day, he observed that price movement alone does not tell the full story. What matters is who is trading, why they are trading, and how urgently they need to act. From these observations, he developed what later became known as market profile, a framework designed to organize market activity in a way that reflects real behavior rather than abstract indicators. Friends, the core idea here is simple but powerful. Markets are auctions. Buyers and sellers are constantly negotiating value. Price moves not because of magic, but because participants disagree on value. When agreement increases, price stabilizes. When disagreement increases, price moves. Schwager explains that Steidlmayer's work helps traders distinguish between two very different types of market activity. One is responsive behavior, where traders react to price reaching areas of perceived value. The other is initiative behavior, where traders push price aggressively away from value due to strong conviction or urgency. This distinction changes how a trader interprets movement. A sharp price move does not automatically mean strength or weakness. It may simply reflect temporary imbalance. Steidlmayer teaches traders to observe whether the market is discovering new value or merely rotating within an accepted range. Friends, this perspective reduces emotional reaction. Instead of chasing movement, the trader observes behavior. Instead of reacting to noise, the trader waits for clarity. Schwager also emphasizes that Steidlmayer's approach encourages patience. Markets spend most of their time in balance, not trend. Many traders lose money during these periods by forcing trades. Steidlmayer's framework helps identify when the market is actually offering opportunity and when it is simply rotating. Steidlmayer's belief that time matters. Price alone is incomplete information. How long price stays at a level reveals acceptance or rejection. This time-based understanding allows traders to judge conviction more accurately. Friends, this is a subtle but critical point. Fast moves that fail quickly often signal emotional excess. Slow, persistent movement suggests genuine participation. By observing time and activity together, traders gain a clearer picture of market intent. Schwager also explores Steidlmayer's disciplined mindset. Despite his deep analytical framework, Steidlmayer never assumes certainty. His work is descriptive, not predictive. It describes what the market is doing and why. Decisions are made in response to observed behavior, not forecasts. This mindset protects traders from ego. When you focus on observation rather than prediction, you stop needing to be right. You simply need to respond appropriately. Steidlmayer's view that markets are social systems. Prices emerge from interaction between participants with different time horizons and objectives. Understanding this interaction helps traders avoid oversimplified interpretations. Schwager includes this interview to expand the reader's understanding beyond charts and indicators. Steidlmayer shows that markets are not random lines. They are expressions of human behavior under constraints. Friends, this part is valuable for traders who feel confused by conflicting signals. Steidlmayer teaches us to step back and ask better questions. What is the market trying to accomplish? Is it accepting price or rejecting it? Who is active and who is waiting? Clarity in trading comes from understanding context, not chasing movement. When you see the market as an auction rather than a prediction machine, decision-making becomes calmer and more precise. Peter Steidlmayer reminds us that successful trading is not about speed. It is about understanding the environment before acting. When you respect structure and behavior, the market begins to make more sense. Part 11. William O'Neill. O'Neill's lesson is powerful because it proves that long-term investing success and short-term trading discipline are not opposites. In fact, O'Neill shows that without trading discipline, even the best investment ideas can fail. William O'Neill's journey began with deep research, not prediction. Schwager explains that O'Neill studied decades of market history, focusing on one central question: what do the biggest winning stocks have in common before they make their major moves? Instead of relying on opinions or economic forecasts, O'Neill analyzed real data, price behavior, volume patterns, earnings growth, and market conditions. From this research, O'Neill developed a clear framework. But what makes this lesson important is not the framework itself. It is how rigidly O'Neill applies discipline to protect capital. He believes that even the best stocks fail if the market environment turns against them. Friends, one of O'Neill's strongest beliefs is that losses must be cut quickly and without hesitation. He does not wait for hope. He does not average down. If a stock moves against him beyond a predefined limit, he exits. This rule is non-negotiable. Schwager emphasizes how emotionally difficult this is for most investors. People fall in love with stories. They become attached to companies. They justify losses with logic and research. O'Neill refuses to do this. He treats stocks as vehicles, not relationships. This detachment allows O'Neill to stay objective. He understands that markets do not reward loyalty. They reward alignment with strength. When a stock stops acting strong, it is no longer worth holding. Another critical theme in this lesson is O'Neill's focus on market timing. O'Neill does not believe in buying stocks simply because they are good companies. He believes in buying strong stocks in strong markets. When the overall market is weak, even the best stocks struggle. This insight protects investors from unnecessary losses. Many people lose money not because they chose bad stocks, but because they ignored market conditions. O'Neill avoids this mistake by aligning individual decisions with broader market trends. Schwager also highlights O'Neill's emphasis on leadership. O'Neill looks for stocks that are already outperforming the market. He does not search for bargains. He searches for strength. This mindset goes against human instinct. Most people want to buy what is cheap. O'Neill buys what is working. Friends, this requires emotional discipline. Buying strength feels risky. Buying weakness feels safe. O'Neill does the opposite of what feels comfortable. He trusts evidence over emotion. O'Neill's respect for rules. O'Neill does not bend rules based on opinion or conviction. Rules exist to protect the trader from emotional decision-making. Once rules are broken, discipline collapses. Schwager explains that O'Neill believes consistency comes not from intelligence, but from obedience to process. When traders begin to justify exceptions, losses expand and confidence erodes. O'Neill also speaks about patience. He does not force trades. He waits for conditions to align. Strong stock, strong market, proper setup. This waiting eliminates many poor decisions. When conditions are absent, he stays out. Friends, this patience is what allows O'Neill to avoid overtrading. Overtrading is often an emotional response to boredom or fear of missing out. O'Neill avoids both by trusting his process. O'Neill's understanding of crowd psychology. He knows that big moves occur when institutions accumulate positions quietly and then push prices higher as demand overwhelms supply. By observing price and volume, O'Neill positions himself alongside institutional behavior rather than against it. Schwager includes this interview to show that successful market participation requires discipline regardless of time horizon. Whether you trade short-term or invest long-term, emotional control and risk management remain essential. Friends, O'Neill's lesson reinforces a central theme of Market Wizards. Success comes from protecting capital first. Profits are the result of discipline, not desire. When you respect rules, cut losses, and align with strength, the market rewards patience. Good ideas do not make money. Good execution does. O'Neill's success comes not from predicting winners, but from managing risk ruthlessly and letting winners grow. William O'Neill teaches us that investing is not about comfort. It is about alignment with reality. When you remove emotion and follow evidence, consistency becomes possible. Part 12. Jim Rogers. Jack Schwager turns to Jim Rogers. This part is about seeing the world clearly and waiting patiently. Rogers is not a trader who reacts to short-term noise. He is a global macro thinker who believes the biggest money is made by understanding long-term cycles and having the discipline to sit still while they unfold. Jim Rogers began his career by studying history, not charts alone. Schwager explains that Rogers believes markets move in long waves driven by supply, demand, politics, demographics, and human behavior. Prices do not rise or fall randomly over decades. They reflect real economic forces. Rogers built his success by identifying those forces early and positioning himself before the crowd recognized them. Friends, this mindset requires a very different kind of patience. Rogers is comfortable doing nothing for long periods. He does not feel pressure to trade just because markets are open. In fact, he believes inactivity is often a sign of clarity. If nothing is clearly mispriced, the correct action is to wait. Schwager highlights that Rogers' confidence comes from understanding, not from action. When Rogers commits to a position, it is because he has strong conviction rooted in fundamentals. But even with conviction, he manages risk carefully. He does not blindly average down or defend positions emotionally. If the underlying premise changes, he exits. Rogers believes that when everyone agrees on a narrative, opportunity is already gone. The best trades emerge when reality diverges from popular belief. This requires independent thinking and the courage to look wrong for a long time. Friends, this is emotionally difficult. Being early feels uncomfortable. Being alone feels risky. Rogers accepts this discomfort as part of the process. He understands that major trends reward patience, not popularity. Schwager also explores Rogers' approach to learning. Rogers is relentlessly curious. He reads widely. He studies geopolitics, agriculture, energy, currencies, and history. This broad perspective allows him to connect dots that others miss. His edge comes from context, not speed. Long-term themes do not move in straight lines. There are drawdowns, false starts, and periods of frustration. Rogers survives these periods because his position sizing allows emotional endurance. He never risks so much that volatility forces him out prematurely. Friends, this ties back to an earlier lesson. Risk management is not just financial. It is psychological. If you cannot emotionally withstand volatility, your thesis does not matter. Schwager emphasizes Rogers' belief that markets eventually tell the truth, but they take their time. Short-term movements are driven by emotion and liquidity. Long-term movements are driven by fundamentals. Rogers aligns himself with the latter. Rogers' respect for reality over narrative. He does not fall in love with stories. He watches actual supply and demand. When facts change, he changes. This flexibility prevents stubbornness. Rogers shows that you do not need to trade frequently to succeed. You need to think clearly, wait patiently, and act decisively when conditions align. Schwager includes Jim Rogers to remind readers that markets reward depth of understanding as much as speed of execution. While others chase short-term excitement, Rogers waits for structural shifts that last years. The biggest opportunities require the greatest patience. When you learn to wait without anxiety and act without hesitation, markets become less stressful and more rewarding. Jim Rogers teaches us that successful trading and investing are not about constant activity. They are about being right at the right time, with enough discipline to hold through uncertainty. Part 13. Tony Saliba. Friends, when Jack Schwager turns to Tony Saliba, the conversation moves into a world that many traders misunderstand: options, probability, and emotional precision. Saliba is not a trader who chases direction. He is a trader who understands structure. His edge does not come from predicting where price will go next. It comes from understanding how risk behaves under different conditions, and how emotion distorts decision-making when probability is ignored. Tony Saliba's background shaped his approach early. He learned quickly that options punish emotional thinking faster than most instruments. Small mistakes can compound rapidly. This forced Saliba to become intensely disciplined. Schwager makes it clear that Saliba's success was built not on bold bets, but on knowing exactly what could happen before entering a trade. Friends, one of Saliba's most important beliefs is that uncertainty is not the enemy. Ignorance is. Options traders must understand the full range of outcomes. If you cannot explain what happens when price moves up, down, or nowhere, you should not be in the trade. This clarity removes emotional surprises. Saliba explains that many traders approach options with directional bias. They want to be right about price. Saliba approaches options as risk structures. He asks different questions. What is my maximum loss? What conditions hurt me the most? What conditions help me? How much time works for or against me? This way of thinking changes everything. Losses become manageable because they are expected. Gains become systematic because they are structured. Emotion loses influence when outcomes are known in advance. Schwager highlights Saliba's emphasis on preparation. Saliba believes the emotional battle in trading is won before the trade is placed. Once a trade is live, it is too late to negotiate with fear. Preparation removes the need for emotional decisions. Emotional stress often comes from uncertainty about consequences. When consequences are clear and acceptable, fear fades. Saliba's respect for probability. He understands that no single trade matters. What matters is expectancy over many trades. This probabilistic mindset prevents emotional overreaction to individual outcomes. A loss is not a failure. It is one data point. Saliba also talks about the danger of overconfidence. Options magnify this danger because leverage creates the illusion of control. Saliba avoids this trap by staying conservative. He does not seek maximum return. He seeks repeatable return with controlled risk. Friends, this discipline protects him during volatile periods. When markets behave unpredictably, traders who rely on opinions suffer. Traders who rely on structure adapt. Schwager also explores Saliba's ability to step aside. Saliba does not trade when conditions are unclear. He understands that forcing trades during low-quality environments increases emotional strain and reduces expectancy. Waiting is part of the job. Saliba does not celebrate wins excessively or dwell on losses. Emotional extremes distort future decisions. By staying neutral, Saliba maintains clarity. Friends, notice how this part connects with earlier ones. Kovner taught emotional survival. Hite taught systems. Seykota taught self-awareness. Saliba shows how structure replaces emotion. When trades are designed properly, discipline becomes natural. Schwager includes this interview to show that markets can be approached from many angles, but the psychological principles remain the same. Whether trading futures, stocks, or options, success comes from preparation, probability, and emotional control. Complexity does not create edge. Understanding does. Saliba's success comes from seeing risk clearly and refusing to act when clarity is absent. Friends, Tony Saliba teaches us that confidence in trading does not come from boldness. It comes from knowing your worst-case scenario and being comfortable with it. When fear is removed through preparation, execution becomes calm and precise. Part 14. Brian Gelber. This part is about objectivity under pressure, how to stay mentally clear when markets move fast, opinions clash, and emotions try to take control. Gelber's edge does not come from bold predictions or complex models. It comes from his ability to stay emotionally detached and respond to what the market is actually doing. Brian Gelber developed his skills in highly competitive, fast-moving environments. Schwager explains that Gelber learned early that the market offers no comfort. It rewards clarity and punishes attachment. Many traders lose not because their analysis is wrong, but because they become emotionally invested in their views. Gelber works relentlessly to avoid that trap. One of Gelber's strongest beliefs is that opinions are dangerous. The moment a trader starts believing too strongly in a market narrative, flexibility disappears. Gelber treats every market view as provisional. It is valid only as long as price behavior confirms it. When price contradicts the idea is discarded without hesitation. Friends, this is harder than it sounds. Human nature wants to defend beliefs. Gelber trains himself to do the opposite. He believes that the market's feedback is always more important than personal reasoning. This belief keeps him aligned with reality instead of ego. Schwager highlights Gelber's focus on execution quality. Gelber does not measure success by profits alone. He measures success by how well he followed his process. If he executes correctly and still loses money, he considers that acceptable. If he makes money but violates discipline, he considers that dangerous. This mindset protects him from emotional extremes. Winning does not inflate his ego. Losing does not damage his confidence. Emotional neutrality allows consistency. Gelber defines risk clearly before entering a trade. He knows where he is wrong. He knows how much he can lose. Once those conditions are violated, the trade is closed. There is no negotiation. Friends, this rule creates freedom. When risk is predefined, fear loses power. Gelber can act decisively because the worst-case scenario is already accepted. Schwager also explores Gelber's belief in mental capital. Gelber understands that emotional energy is limited. Poor trades, emotional reactions, and overtrading drain mental resources. To protect mental capital, Gelber trades selectively. He avoids marginal setups and noisy environments. This selectivity is not about caution. It is about efficiency. Gelber wants his attention focused when conditions are clear. This improves decision quality and reduces fatigue. Another subtle but powerful idea in this lesson is Gelber's awareness of emotional signals. When he feels frustration, excitement, or urgency, he interprets these emotions as warnings. Emotional intensity often signals reduced clarity. When this happens, he steps back rather than pushing forward. Friends, this practice prevents impulsive behavior. Many traders interpret emotional intensity as conviction. Gelber interprets it as risk. Schwager includes Brian Gelber to demonstrate that trading is as much about how you think as what you think. The best traders constantly monitor their internal state. They know that emotional imbalance leads to poor decisions, regardless of market conditions. Objectivity is not a personality trait. It is a discipline. It must be practiced daily, protected from ego, and reinforced through rules. Brian Gelber teaches us that success in trading is not about having strong opinions. It is about having weak attachment. When you stay flexible, neutral, and disciplined, the market becomes less threatening and more navigable. Part 15. Jeffrey Yass. The book moves into one of the most intellectually demanding lessons: pure probabilistic thinking. Yass is not interested in stories, opinions, or predictions. He is interested in odds. His edge comes from seeing markets the way a professional gambler sees games, not as certainties, but as repeated bets with positive expectancy. Jeffrey Yass approaches trading with one foundational belief: being right is irrelevant. What matters is whether the odds favor you over a large number of trades. This idea sounds simple, but emotionally it is extremely difficult. Most people want validation. They want to feel correct. Yass does not care about correctness. He cares about expected value. Schwager explains that Yass evaluates trades the same way a casino evaluates games. A casino does not worry about individual outcomes. It knows that over time, favorable odds produce profits. Losses are not failures. They are part of the distribution. Yass applies this mindset rigorously to markets. Friends, this perspective changes everything. When you truly accept probability, fear loses its grip. A losing trade does not hurt your confidence. A winning trade does not inflate your ego. Each outcome is just one roll of the dice in a long series. Yass is extremely disciplined about position sizing. Even when the odds are favorable, he never risks too much. He understands that probability works only when capital survives variance. Overexposure destroys even the best edge. This respect for variance keeps him emotionally stable during inevitable drawdowns. Schwager also highlights Yass's ability to think independently. Yass does not follow crowds. He looks for situations where prices are misaligned with true probabilities. This often means taking positions that feel uncomfortable or unpopular. Yass accepts this discomfort because he trusts the math, not the crowd. Friends, emotional discomfort often signals opportunity, but only when supported by logic and risk control. Yass does not chase discomfort blindly. He quantifies it. Yass's detachment from outcomes. He does not review trades emotionally. He reviews them statistically. Did the trade follow the model? Did the odds justify the risk? If yes, the outcome does not matter. This mindset protects him from hindsight bias and emotional distortion. Schwager emphasizes that Yass avoids overtrading. He waits for situations where the edge is clear. Random activity dilutes expectancy and increases emotional fatigue. Patience preserves clarity. Friends, Yass's approach is demanding. It requires emotional maturity and intellectual honesty. You must accept long losing streaks without abandoning discipline. You must accept wins without becoming overconfident. Very few traders can do this consistently. Markets reward those who can think in probabilities rather than certainties. Jeffrey Yass shows us that trading success is not about prediction. It is about repeatedly placing small bets with favorable odds and letting time do the work. Part 16. Eli Tullis. Eli Tullis's career was shaped by time spent in commodities markets, environments where volatility is common and certainty is rare. Schwager explains that early on, Tullis learned a hard lesson. Activity does not equal productivity. Trading frequently did not make him smarter or richer. It only increased exposure to emotional mistakes. Over time, he realized that his edge came not from constant engagement, but from selective participation. Friends, this realization changed everything. Tullis stopped asking, "What can I trade today?" and started asking, "Is there anything worth trading at all?" Most days the answer was no, and he became comfortable with that. Tullis's belief that good trading often feels boring. When conditions are clear, decisions are straightforward. There is no drama, no rush, no emotional spike. When trading feels exciting, Tullis becomes suspicious. Excitement usually means uncertainty or ego is involved. Schwager highlights Tullis's deep respect for market cycles. He understands that markets move through phases: accumulation, expansion, distribution, and contraction. Not every phase offers opportunity. Trying to force trades during quiet or unclear phases only increases frustration. Friends, this patience requires emotional strength. Many traders feel uncomfortable sitting on the sidelines. They fear missing out. Tullis does not. He trusts that markets always provide future opportunities. Missing one move does not matter. Preserving clarity does. Schwager explores is Tullis's reliance on judgment refined by experience. He does not rely heavily on rigid systems or indicators. Instead, he integrates information from price behavior, fundamentals, sentiment, and market structure. This integration is not random. It is the result of years of observing how markets react under different conditions. Friends, this kind of judgment cannot be rushed. It develops slowly, through mistakes and reflection. Tullis openly acknowledges that many of his early losses were necessary teachers. Instead of blaming the market, he learned to adjust behavior. Schwager also emphasizes Tullis's conservative approach to risk. Even when Tullis feels strongly about a trade, he never risks enough to disturb his emotional balance. He understands that emotional stability is a trading asset. Losing it damages decision-making. Tullis's belief that markets do not owe you anything. There is no fairness, no obligation. Accepting this removes frustration. When traders expect markets to behave a certain way, disappointment leads to emotional reactions. Tullis avoids this by accepting uncertainty completely. Friends, this acceptance allows him to remain calm during drawdowns. Losses do not surprise him. They are part of the environment. What matters is how he responds. Schwager includes Eli Tullis to show that not all edges are fast or aggressive. Some are quiet, slow, and built on restraint. Tullis represents the trader who survives by avoiding unnecessary exposure and acting only when conviction is supported by conditions. Experience teaches patience, but only if the trader is willing to listen. Tullis's success comes from respecting time, uncertainty, and his own emotional limits. Eli Tullis teaches us that trading is not about proving intelligence. It is about preserving clarity. When you stop forcing action and start respecting conditions, the market becomes less stressful and more manageable. Part 17. Monroe Trout. This lesson is about treating trading as a business. Nothing more, nothing less. Monroe Trout approaches markets with one overriding belief. Survival is the first requirement of success. Without survival, skill does not matter. Intelligence does not matter. Experience does not matter. Everything begins with protecting capital. Schwager emphasizes that Trout's consistency comes from his refusal to expose himself to unnecessary risk, regardless of how attractive a trade appears. Trout believes that most traders fail not because they lack opportunity, but because they lack restraint. They take risks that are emotionally or financially excessive. When volatility hits, they break down. Trout avoids this by controlling position size with mathematical discipline. He risks only a small, predefined percentage of capital on each trade. This rule never changes. Whether he feels confident or uncertain, the rule stays the same. This consistency protects him from emotional decision-making. Schwager highlights Trout's belief that drawdowns are inevitable, but destruction is optional. Losing periods happen to every trader. What determines survival is how much damage those periods can inflict. By keeping losses small and consistent, Trout ensures that no drawdown threatens long-term viability. This approach removes fear. When you know that no single trade or series of trades can harm you significantly, emotional pressure fades. Decisions become calmer. Execution improves. Trout's separation of identity from outcomes. Trout does not measure self-worth by profits or losses. Trading results are business results, not personal judgments. This detachment allows him to remain objective and disciplined even during difficult periods. Schwager also explores Trout's systematic thinking. Trout prefers clear rules over subjective judgment. Rules reduce ambiguity. Ambiguity fuels emotion. By minimizing ambiguity, Trout minimizes emotional interference. Trout's respect for longevity. Trout is not interested in spectacular short-term results. He is interested in repeatability. His goal is to trade well year after year, regardless of market conditions. This long-term orientation influences every decision he makes. Schwager emphasizes that Trout avoids overconfidence at all costs. Winning periods do not lead to increased risk. Success does not change rules. This is rare. Many traders increase size after winning, exposing themselves to larger emotional swings. Trout refuses to do this. Friends, this discipline is what allows him to remain consistent across different market environments. He does not need markets to behave a certain way to survive. He adapts by controlling exposure. Trout's focus on process evaluation. Trout reviews his performance based on adherence to rules, not outcomes. If he followed his process correctly, he considers the period successful, even if results were negative. This mindset protects confidence and prevents emotional drift. Schwager includes Monroe Trout as the final lesson because he embodies the core message of Market Wizards. Trading success is not about brilliance. It is about behavior. When behavior is controlled, results become stable. Markets are unpredictable. Strategies vary. Styles differ. But risk discipline, emotional control, and professionalism are universal. Monroe Trout shows us that trading is not a game of courage. It is a game of control. When you respect risk, follow rules, and remove ego from decision-making, the market becomes something you can engage with calmly and consistently. By ending of the book, Jack Schwager delivers his final message without saying it directly. The ultimate edge in trading is discipline sustained over time. Survival creates opportunity. Discipline turns opportunity into consistency. So friends, you've just completed a journey through the minds of some of the greatest traders the markets have ever known. Not strategies, not shortcuts, but ways of thinking. Through the words and insights shared by Jack Schwager and Market Wizards, you've seen one powerful truth repeated again and again. Success in the markets is not about predicting the future. It's about controlling yourself in uncertainty. Each trader you heard from was different. Different styles, different personalities, different markets, yet they all shared the same foundation: discipline, risk control, patience, and emotional awareness. If you listened carefully, you probably noticed something important. None of them chased excitement. None of them tried to impress the market. They focused on survival first and consistency second. Friends, if even one lesson from this audiobook helped you think more clearly about risk, decision-making, or patience, then this time was well spent. If you found value in this audiobook, please like this video. It helps this content reach more people who are serious about learning, not gambling. Share it with a friend who is struggling with trading psychology or emotional discipline. Sometimes one right idea, heard at the right time, can change a whole journey. And if you want more deep, practical audiobook content on trading psychology, finance, investing, and decision-making, subscribe to the channel and stay connected. More lessons are coming. Thank you for listening till the end, friends. Stay disciplined, protect your capital, and trade with awareness.